Emil, I think this what we're going to talk about here is we need to cancel student loans, right? I mean, that's the big thing nowadays. Students who have gone to higher education, university colleges, have racked up enormous amounts of debts through no fault of their own. They must be given some kind of debt relief because it's an economic thing. You know, this debt is holding back potential consumers from being able to, and not, I mean, just straight up live their lives and be able to do things that the prior generations have been able to do. But why are we canceling student debt? Why are debt levels so high? Why is it so far out of whack compared to maybe what the actual economic situation is as far as the labor market goes?
So the article in question is polar opposite sides of consumer credit end up pointing in the same place, jobs. That was posted on December 7th at the Alhambra Investments blog. And you make the point that there's a problem.
There is a problem. It's a huge problem. In fact, when you look at consumer credit, there's an elephant in consumer credit. It's not what you think. In fact, consumer credit is an all-time high or near an all-time high, an extreme high. I think it's, since 2008, consumer credit overall, according to the Federal Reserve's numbers, has grown something like 70%, which sounds like, hey, this narrative that we're in a credit bubble stimulated by the Federal Reserve's low interest rates, therefore it's coming out in consumer credit. And look at what's going on there. It's a big, huge problem.
Jeff, non-revolving credit increased $12.7 billion in October, but that is mostly government funding to what all appearances is unproductive investment in college education. But revolving credit decreased by $5.5 billion, and that's not just the 1 month trend.
There's a huge difference between what's going on with the government. But the government doesn't care about economic factors. The government only cares about demand. And so therefore it's going to supply as much credit as is demanded. Whereas on the flip side, when you remove the government elephant from the consumer credit figures, what you find is, unfortunately, there isn't been a lot of consumer credit. And I say unfortunately because this is a debt, debt is an essential component to the modern financialized economy. And you look at revolving consumer credit by contrast, and it is a huge contrast. In fact, the revolving consumer credit balances in the aggregate continue to decline, even into, I believe these numbers are for October 2020, which is supposed to be a recovery. It's supposed to be the economy getting back. And what you see is revolving consumer credit as opposed to government student loans, government credit through student loans, is that this is what consumers are telling you they believe is going on in the U.S. economy. It's not debt charge-off. It's not the lower levels of the income tiers that are reducing their aggregate credit balances. It's higher levels of income tiers that are saying, we're so concerned about our future, we're going to pay down or not even take on new revolving credit balances. And so it's this dichotomy between the government supplying whatever is demanded in terms of consumer loans, whereas in revolving credit, consumers are saying we don't want to borrow because we're scared. We're afraid that we don't know our job situation is going to be in the near term or intermediate term. We're acting out of prudence. So the government is imprudent. Student loans, college-age kids rack up more debt than they really need to. And oh, by the way, then they graduate into a jobs market that is so awful, they have no chance. They got all this debt, hoping to get a really, really good job when there are very few really good jobs available. So the opposite ends of the consumer credit spectrum telling you essentially the same thing, which is labor market, jobs. It's really not good.
And what about the recent jobs data? What have you seen there? Have we seen any improvement or improvement at a rate that is accelerating, or is it still decelerating?
No, and that's a good point, Emil, because I think we do need to be clear about this. It's not like the jobs market is contracting again. It's not like we've gone into recession. But in some ways, you don't need to. This is just as bad because we're already in recession. We already had the massive economic hole earlier this year, and now we're trying to climb our way out of it. And so the rate that we climb our way out of it is everything. That's all that's really important. And if the rate is not sufficient, that means we're going to be stuck in recession for a prolonged period, which is, again, what the revolving consumer credit is telling you. Consumers are worried about the labor market situation lingering forward too much longer. And when we look at things like jobless claims or even just the payroll numbers from last month and the last couple months, what we see is that, look, no, the economy stopped recovering at the V-shaped rebound reopening frenzy rate that it had initially done, back in May and June. Somewhere around June and July, things radically changed. The economy stopped rebounding at the same robust rate that it had initially. And ever since then, as we've seen in the labor market, especially jobless claims, which absolutely exploded last week, they're up to 850,000 initial claims, which is an enormous number. So what we're seeing in the labor market is, yes, it's improving, but these improvements are getting smaller and smaller and smaller, and the rate of improvement overall has gotten to the point where we're kind of stalling out and stagnating. We're not falling back just yet, but it's at a rate where right now in November and December 2020, we're in worse shape than we were at the worst part of the Great Recession. And that, I think, should really open people's eyes, understanding that here we are 9 months later, and we're still materially worse in the labor market than it ever had gotten in 2008 and 2009.
So the initial claims for unemployment insurance had been in the 700,000s, had been getting smaller, then it jumped up. Is there any word from the Bureau of Labor Statistics or whoever calculates these numbers? Was it a data discontinuity? Was it a catch-up on states that hadn't been reporting? Or was there any, or is this something worse?
Well, a lot of people are attributed to the reimposed restrictions, lockdowns, and things like that. And I think that that's absolutely part of it. But I think that's overdone too. I think the economic damage that we're seeing in the labor market is economic damage. It's not artificial restrictions. Talk about the local pub or the local restaurants that are suffering, and they are. But that's not really what we're seeing in the labor market numbers. The labor market numbers are saying that this is economic damage across a wide swath of industries, including many industries who aren't nominally affected by these renewed social distancing and other restrictions against indoor dining, for example. That's not what you're seeing in jobless claim numbers. You're seeing companies that have held out for 9 months expecting the economy to recover, finally saying, look, I don't see it. Things slow down June and July. It looks like we're not good. It's not really going to get much better. We've held on as long as we can. I'm sorry, but I'm going to have to give you I'm going to give you your pink slip because I just can't hang on anymore. It's economic damage that is built up because, yes, the economy is improving, but it's not improving at anywhere close to a sufficient rate. And bringing this back to our earlier discussions about inflation, how the hell are you going to get inflation when we're stuck in a labor market that is fully and completely deflationary?
Jeff, are there any final words that you wanted to share with the audience this week?
No, I think that's really the overall thing is that, when we look at the inflation story, especially how it's characterized overall in the media, it's premature celebration. And that's really my point in bringing this back to 2017, 2018 was like, hey, we've done this before. Premature, you spiked the ball way too early in 2017 and 2018. And back then, you actually had some things going that at least plausibly seem to be going in your favor. In every single category now in 2020, you have even less. In 2017, 2018 did not lead to the inflationary breakout that everybody promised. And now that you have even less going for it, we're supposed to, this time it will work. Come on. Again, that's why I say, for markets, they're behaving far more rationally. And I think for, especially when you look at some of the public surveys, which we might get into next week, there's really not this widespread belief in inflation because how can there be? We are in a recession right now, a recession whose recovery has stalled out, as I just said, for the labor market at a place that was worse than the worst spot of the Great Recession. That's not inflation. There's no inflation indicated anywhere here.
Let's take it up again next week. It'll be our final show for the year. I'll talk to you next week, Jeff.
All right, Emil. Take care.